Welcome to Digital Wealth Code, the channel where we break down markets, money, and smart investing strategies. In today's video, we're covering 10 types of stocks that could crash in a recession, with real company examples. Economic downturns often expose weak balance sheets, excessive debt, and unrealistic valuations. Knowing what to avoid can be just as important as knowing what to buy. Before we begin, make sure to subscribe to Digital Wealth Code for more stock market insights. This video is for educational purposes only and is not financial advice. Always do your own research or consult a financial professional before investing. Let's get started. Airline stocks are among the most vulnerable during recessions. Companies like American Airlines, United Airlines, and Delta rely heavily on consistent travel demand. During economic downturns, both business and leisure travel decline sharply. Despite lower demand, airlines still face high fixed costs. Aircraft leases, fuel expenses, and labor costs remain. Many airlines also carry large amounts of debt from past crises. Higher interest rates make refinancing that debt more difficult. This combination can severely pressure airline stock prices. Luxury brands depend on discretionary consumer spending. Companies like LVMH, Gucci's parent Kering, and Burberry thrive when confidence is high. During recessions, consumers delay luxury purchases. Even high-income households become more cautious. Excess inventory can build quickly. Brands may be forced to discount products. That leads to margin compression. Stock valuations can fall rapidly. Unprofitable tech companies struggle when money becomes tight. Examples include early-stage software or platform companies with no earnings. These firms often rely on investor funding to survive. Recessions reduce access to cheap capital. Investors shift focus toward profitability. Cash burn becomes a major concern. Layoffs and spending cuts slow growth. Stock prices often collapse under pressure. Highly leveraged real estate companies face serious recession risks. Some REITs with high debt levels are especially exposed. Office-focused REITs like Vornado or SL Green face added pressure. Tenant defaults can rise during downturns. Vacancy rates may increase. Debt payments remain fixed regardless of income. Falling property values weaken balance sheets. This can severely impact shareholder returns. Auto manufacturers are highly cyclical businesses. Companies like Ford, General Motors, and Stellantis are sensitive to economic conditions. Car purchases are often delayed during recessions. Consumers hold onto vehicles longer. Sales volumes drop quickly. Manufacturers still carry high production costs. Inventory can pile up. Profit margins shrink under discounting pressure. Media companies dependent on advertising are also vulnerable. Firms like Snap, Pinterest, and traditional media networks rely heavily on ad spending. During recessions, companies reduce marketing budgets. Ad demand falls rapidly. Competition for remaining ad dollars increases. Pricing power weakens. Revenue growth slows or reverses. Stock prices often reflect this quickly. High-end consumer electronics companies face demand risk. Companies like Apple sell premium-priced devices. During recessions, consumers delay upgrades. Replacement cycles lengthen. Sales volumes may soften. Inventory risks increase. Global demand weakness adds pressure. Valuations can compress rapidly. Speculative biotech companies carry extreme downside risk. Many small biotech firms generate little or no revenue. They depend on funding to continue research. Examples include early-stage drug developers. Recessions reduce investor appetite for risk. Capital becomes harder to raise. Negative trial results can be devastating. Some companies fail entirely. Retailers with weak balance sheets struggle the most. Examples include heavily indebted retail chains. Companies like Bed Bath & Beyond, before bankruptcy, showed these risks clearly. Consumer spending shifts toward essentials. Discretionary retail sales decline. High inventory leads to discounting. Margins collapse. Store closures often follow. Overvalued growth stocks are often hit the hardest. These stocks trade at high multiples based on future expectations. Examples include popular momentum-driven tech stocks. When growth slows, expectations reset. Valuation multiples compress rapidly. Investor sentiment can reverse quickly. Even strong companies can see major drawdowns. Price matters most during downturns. Recessions don't impact all stocks equally. Companies with strong balance sheets perform better. Consistent cash flow becomes critical. Low debt provides flexibility. Risk management is essential for long-term investors. Avoiding major losses protects future gains. Preparation beats panic. If you found this video helpful, consider giving it a like. Subscribe to Digital Wealth Code for more investing insights. Thanks for watching, and I'll see you in the next video.